Greeting of the day to your all students. Hope you have learned from the last session that we discussed about investment portfolio. That is about how to calculate HPY and how to calculate HPR, and then we discuss how to calculate for the single investment analysis and for the portfolio investment analysis. So we did calculations based on different formulas that we have. We discuss about arithmetic means and geometric means. Today we'll discuss about the again risk perspective, that how to calculate risk and what is risk actually which we have. Risk is nothing. In today's channel you will learn the risk return, standard deviation, and then you will learn about the standard deviation. If you see that in the previous decision we discussed that we are investing the allocation of money for the positive return. So when it is positive return, so we have to we should expected certain risk is right. So if you're not expected, your return will be not growth. So for that purpose, so risk is what? Risk is the uncertainty of risk is the uncertainty of risk is the uncertainty of expected losses which happening in the future. That is called what? Risk. Simple definition. So we are defining risk. Risk is nothing. It is the unexpected events or the unexpected losses which is happening in the future, or which we cannot it is not happened yet, right? So that is what risk is. Now how to calculate risk? We have two different ways. First of all, we have to know what is probably expected return, and then based on the expected return how to calculate risk. We have a for variance for that power formula, and then for the we have standard deviation for the calculation. So the purpose today will discuss about variance, standard deviation, and risk. Other things will be how to measure the relative risk, that will be discussed in the next session. If you see that for expected return is the return which is you are expected based on your risk which you are accepting, right? So that is what called expected return. As you see in the slide, it's clearly written. Expected return is equal to the probability of return multiplied by estimated return. So probability return is giving to you people, so you have to calculate based on the probability return your estimated risk. Suppose how to calculate. So here if we are saying that how to measure expected risk, and then about going ahead for the return. So expected return we said as symbolic ER, right? ER is equal to probability. What is my probability? If you see a perfect certainty where investor is absolute certain of return, certain means risk of the return 5%. So it assuming that 5%. So when we are writing 0.5, right? Multiply by what? Perfect certainty allows that only one possible return. So it give us that there is one chance of return that we have. So that is what? It is 1. So multiply by 1. So my expected return will be how much? 0.5. So this is the expectations that I expect this much returns, because we says in the investment that if you see that higher risk is higher the return, right? So higher risk which we have, that is again if we are considering, that is again the risk will be also calculated from that perspective, right? So here the rate of return is 5%, right? So even an example is giving that we have 5% return. So from this example we call that, we can say that we have 5% returns based on the 5% risk which I have. See, in the example is also there shows that how to distribute the risk and investment. So my probability is right one. So the return is how much? I will be having return 5%. So probability is 1 and my return will be 5%. This is how to calculate. If you see, if I have that is just one single investment is giving for you, so you can calculate single expected return. If economy situation is different, surrounding there is boom, right, and there is low economy, high economy, average. So how to calculate for that different situation the risk for the organization? See, here giving that 3 scenario based on the past experience and current outlook as follows. That economy have 3 conditions: strong economy, weak economy, no major change, which is normal economy we have. And probability is given 15%, 15% and 70%, and then 20% is the return, and then minus 20% is again the return when the economy is low, and then when economy is average or normal, it have a 10% return. So how to calculate this expected return for this, right? So my expected return will be calculating that. We said that what is my formula? Expected return, I am just using symbol, right, equal probability multiply by return, right? So if you see there, I have given to me 3 different situations, so I have to calculate ER for all of these, right? So if I want to calculate, so ER is equal to what? Probability of the first one 0.15, right, bracket start, multiply by 0.2, which is 20%, right, close the bracket, plus the probability of second one 0.15 multiply by probability of the second minus 0. Return of the second to 0, right? So bracket start and bracket close, plus the brackets are 0.7 multiply by probability of return of that 0.10. So now that is what the expected return you will receive. So if you calculate this expected return from these questions, so how you will get to analyze this? What is the expected return? 0.15, right? So if you have a calculator, so you can use it. 0.15 multiply by 0.20, that is 0.03. So here it will be equal to 0.03, right? So I have the second one is 0.15 multiply by minus 0.20, 0.3, it is minus 0.03. Again, if you calculate the last one, so 0.70 multiplied by 0.10, it will be equal to 0.07. So it will be equal to 0.07. So it means that my expected return is how much? 7%. So this is what my expected return which I am receiving. So 0.7% is the return which, if I have a risk overall in the probability, that risk is n%, and I have these different return, that expected return will be happening this much based on these risk and based on this return. So this is how to get the calculate for that. Suppose there is another example is given that you will be doing it with yourself, that how to calculate if other risk is given. Suppose it is giving the 10 possible way, it means we have 0.4, right, and then we have the next risk is 0. Minus, sorry, let me clear this. I may have like minus 0.30. I have a risk of minus 0.20. Again I have a risk of minus 0.10. I have risk of 0.0, right? I have a risk of 0.10. I have a risk of 0.20. I have a risk of 0.30, and also I have a risk of 0.40, right? So this is the risk. So this is see the possible outcome, which range from 40% to 50, and to 40% to 50%, the same probability for each. So my probability is how much? It will be equal to 0.05. Just 50, oh sorry, 50% is there. I think it is what I can say, it is 50, right? So you can write down 0.5. This is the probability, right? So here the P is given to you, and then what you need to do, you need to calculate, right? So based on that figures, so you will have these different returns, and based on these returns you will calculate what? Expected return. I hope it is easy. I think it is not a very difficult that you can do it by yourself, because if you calculate like the first one, minus 40.40 multiply by 5, right? So this is what you will get, that how to calculate the expected return, plus the next one minus 0.30 multiply by 0.5. So here also we have 0.5, so the multiply symbol is here, right? So this is what we have, 0, right? So how to calculate? And then the next one, plus bracket start minus 0.20 multiply by 0.05. You will do this for the entire till that you have to do till here, that 0.40, the last one I will do, and then multiply by 0.50, right? So you will multiply that by this. This is how to calculate the expected return for this example. So this is the return, and you will get the rate that which is you will give the expected return that you have. Now how to calculate the again about which we have expected return, right? So how to calculate the risk for that, so that if you want to calculate that was the expected return, the risk for that, so we have to calculate variances. So what is the formula for the variance? So it is equal to probability multiplied by possible return minus expected return. So this is the formula, simple. So if you see, we solve the first questions like we have how much 5% multiplied by 1, so expected return for the first one 0.5 multiplied by 1, right? Remember, it will be equal to how much? 5%, 0. It is 0.05, right? So it will be equal to 0.05. So that is my expected return. So if you calculate that how much is your that you have, suppose you will receive, or the risk is how much. So if you calculate risk, we said it is equal to probability multiply by possible return. If you are going to formula, so possible return minus expected return. So possible return, so PR or estimated return minus expected return, right? Square it. Now, so probability is how much? We have the probability of how much here in the question, that if you see we did in the last session, that when we are going to open the slides, and we have, like, let me open the let me show you that. See, here is the very first question. So my probability is 1 and my expected return is 0.05, so right, so I have find it. If I want to do here, so my probability is how much? Again, it is 1. So 1 multiplied by, so probability of return is how much? 0.05 minus expected return. So expected return I have calculated 0.05, so square it, right? So 0.05 minus 0.05, 0. 0 square is 0. 0 multiplied by 1, 0. So my variance here, variance or risk, will be equal to how much? My variance or risk will be equal to 0. So I have no risk in this case because situation is normal, there is no risk, and then we have a less profit in this situation. So my risk is less, so my profit is less. If you see the second example, I have calculated this, that expected return is 7. So how to calculate variance? So we are having symbol for the variance like this. I want to clear, let me so I have formula for this variance. So equal to probability multiply by possible return minus expected return, right? Square it. So this is what you calculate the expected return. So now what happened to calculate variance? So you will get what? Probability. So my probability is given for the first question 0.15, right? Multiply by expected probability of return, or the rate of return, which is 0.20, power minus expected return is 0.07, right? Plus the next return is 0.15, right? Probability multiply by minus 0.20, right? Then minus expected return 0.07 plus the next return is 0. Which I have expressed possibility 0.70 multiply by So the risk is here, the return is 0.10 minus expected return. So expected return is 7%, so 0.07 square of it, right? So this is also have a square, all of them need to be squared, so you will get the risk, correct, variances. So how to calculate this? The very first one, if you calculate that 0.20 minus 0.07, it will be equal to how much? 0.13. So 0.13 square, so it will be equal to 0.016 multiplied by 0.15, which is the probability. So it will be equal to how much? As 0.025. So the variance for the first project equal to 0.0026, right, plus the next one. So minus, it will become minus 20, 0.20 plus minus 2.20, it will become 0.27 multiply by 0. Minus 0.27, which is square, it's 7.029 multiply by 0.15, right? So it will be equal to 0. The second one, 0.109 plus the next one. If you calculate that, 0.10 minus 0.07, it will be equal to 0.03 multiply by square it, 0.03 multiply by 0. Probability 7, right? So it will go to 0.0063, 0.00063. Now you need to add and deduct this one, right? So this is the symbol is minus, because we minus into minus, minus will be equal. So 0.0026 plus minus 0.109 plus 0.0063, it is 10. So my variance will become minus 10, right? So my variance is here minus 10. So this is how to get the calculate for the variances. So for the third example, you need to do in the same way that you have to calculate this, how to calculate the measure the risk and expected return of that. So then we'll in the next session discuss about the comparing and how to minimize risk and how to calculate different investment. I hope you have learned something from today's session, and thank you so much for your attention watching videos. If you have any questions, you can contact me in, through YouTube channel or my WhatsApp number.